Hello dears, how are you? I hope that you are doing well. Today we are going to take part 2 of revision for this course. So first, let us talk about business failure fundamentals. A business failure can be viewed in a number of ways and can result from one or more causes. Okay, so types of business failure. What do we mean by business failure at first? When firms may fail because of what? Because of its return are negative or low or below. Okay? So if the firm fails to earn a return that is greater than its cost, this means that we have a negative or low returns, which as a result make the business failure. So the second type of failure, or this type of failure, occurs when a firm is unable to pay its liabilities. If you remember, in Financial Accounting 1, we have assets equal liabilities plus owner's equity. So if this company failed to pay its liabilities, this means that we have a type of failure for this firm. So when a firm is insolvent, its assets are still greater than its liabilities, but it's converted with a liquidity crisis. So we didn't have liquidity, we didn't have cash money, we cannot pay our liabilities. So this means that we have a type of failure. So if some of its assets can be converted into cash within a reasonable period, this means that we can be able to escape from the complete failure that we have. So the result is the third and most serious type of failure, which is bankruptcy. What do we mean by this? Bankruptcy occurs when the stated value of firm's liabilities exceeds the fair value or the fair market value of its assets. We agree that assets equal liabilities and owner's equity, and if we cannot pay our liabilities, this means that we are going to fail. So when the firm's liabilities, the stated value of the firm's liabilities exceeds the fair value of or the fair market value of its assets, this means that we have not have liquidity for more than their book value, which means that we are going to have the bankruptcy. So what about the major causes of business failure? The primary cause of business failure is the mismanagement. The management cannot play its role correctly, which accounts for more than 50% of all cases. So if we have a failure or if we have a business failure, the major cause is the mismanagement, that the management cannot play its role correctly. So specific managerial faults can cause the firm to fail. Okay? To fail by what? By overexpansion, by poor financial actions, and ineffective sales force, and so on. So let's take more details. We have something called voluntary settlements. What do we mean by voluntary settlements? The settlement is normally initiated by the debtor of the firm, because such an arrangement may to be liquidated in a manner that gives the owner the greatest chance of recovering the part of their investment. So if I can recover the part of the investment, then I will make the settlement. So when a firm becomes insolvent or bankrupted, it may arrange with its creditors, which enables it to bypass or to bypass many of the costs involved in the legal bankruptcy proceedings. So the settlement here is to recover in a liquidated manner to have a part of investment, the greatest part of investment to be recovered, to have the voluntary settlements. Okay, so we have a nature of corporate failure for the various decision patterns. Those various decision patterns can be the definition or the define of the strategic nature of the business, the production or to produce the major policy, as well as the plan to achieve objectives and goals for this corporation, and to shape and reveal its objectives and goals. Okay, so we have a nature of corporate failure, that any corporate strategy is intended to meet the demand of the marketplace in order to generate its profits. So there are three types of corporate failure that could easily be identified, like a corporate body with lower or negative returns, corporate body with a technically insolvent, and corporate body which is bankrupted. Okay, so if I have a negative or low returns, if I have a technically insolvent, if I'm bankrupted, this means that I have the three types of corporate failure. So next, the assets of the firm may be higher than its liabilities, but because of its critical liquidity, I don't have cash, I don't have a liquidity situation, so it's unable to meet its liability, so I cannot pay my liabilities, so I'm going to the corporate failure. Do you get it? Okay, so a firm that is bankrupted is found in a situation where the total assets is less than the total liabilities. That the ratio between assets and liabilities is less than 1. So if I cannot pay my liabilities, or if assets is greater than are greater than liabilities, but I don't have a liquidity situation, or I don't have enough cash, this means that the ratio between assets and liabilities is less than 1. So we are going to have an introduction or talk in more details about the business failure fundamentals. Corporate failure effects such as managerial inefficiency, cultural factors, economic instability, public policy, etc. So the managerial inefficiency and ineffectiveness means that the company are going to face the corporate failure because its management cannot have the or cannot play its correctly rule. So the managerial inefficiency and ineffectiveness can be like the like the high production cost, or it can be presented in the ineffective sales force, or it can be presented in the low of productivity, poor financial management strategy, and poor risk assessment strategy, which means that the management cannot make strategies and cannot take decisions, so they play their roles in an inefficiency and ineffectiveness way. We are going to have a corporate failure with this over. So ineffective sales force mean that the end result of production is to sell the product. This is our objective. Do we agree by this? Okay. So if the sales force is not trained and developed, the company may find it difficult to sell its product, especially if the product is sold in a highly competitive market. So if I am in a highly competitive market and I cannot sell my products, this means that I have ineffective sales force, and this will make me go to the corporate failure. So I need to do what? I need to have an effective sales force. But if I have an ineffective sales force, this means that I cannot sell my products in the market, and this means that I'm going to the corporate. So the high production costs can go to, or can lead us to go through the stage, or go through the scale, or go through, sorry, the step of corporate failure is the high production costs, as this is a situation where the production cost of the fair market for each product not to compete with other differentiated products in the market. This means that we have a higher production cost and we cannot sell our products, so sure we will go, or of course we will go through the corporate failure. So the high production cost is the situation where the production cost of the firm make its product not to compete with the other differentiated products. I have another products in the competitive market which have a lower price and higher quality. So the customer will take this product and leave my product. So I will get my high production cost in my company and I cannot sell my products, so I will go to the corporate. And this leads us to think about the management. This means that this management or this management department in this factory or in this corporation have a poor financial strategy. They cannot make a financial management or financial strategy that the firm who's the financial manager which is unable to take effective financial management decisions, this will make us face the corporate failure. So the financial management should take decisions. Such decisions is like decisions that include investment financing and dividend policy decisions. Try to do anything to this corporation to avoid the poor financial management. So what about the risk assessment strategy? This management should have a risk assessment strategy. What do I mean by risk assessment strategy? The risk that associated with an investment decision should be evaluated. So the management here should evaluate or have a risk assessment strategy to avoid having the corporate failure. Thus, if the risk assessment is not properly done, corporate income will be impaired. So what about inappropriate commercial policy? Policies affecting sales, especially credit sales, should be carefully evaluated. So if the management have policies to affect sales, especially the credit sales, and this credit sales be carefully evaluated, we will avoid the corporate failure. So what about the absence of manpower training and development policy? A firm that does not have manpower training and development policy cannot make use of well-trained and specialized staff that can help in the achievement of corporate objectives. So here I need to have a development, I need to have a manpower training, I need to avoid any mistakes in the specialized staff that can help in achievement of corporate objectives. So if we achieve the corporate objectives, we will avoid what do we call the corporate failure. So an evaluation of strategic businesses units will show average poor performance of staff in the critical positions in the organization. So the capital inadequacy means that the firm is undercapitalized to fail sooner or later. This company or this firm or this corporation, sooner or later it will be failed, will face the corporate failure, and the reason is that the firm will not have enough capital to buy the relevant fixed assets. I don't have capital. In the previous case, I cannot pay liabilities. So if I cannot pay liabilities, if I cannot have enough capital to buy the relevant fixed assets, I will face the corporate. So what about the cultural factors? A firm that produces products which are not absorbed by the immediate environment, it will force the firm to look for distant markets, which will lead to higher marketing costs and inability to sell its products. What do we mean by this paragraph? We agreed that we are in a competitive market, and the companies that face the corporate failure cannot sell its products in the competitive market because they have a higher production cost, and this will lead to a higher price of this product, and the customer need the highest quality with the lowest price, so I cannot sell my product, so I'm going to have the corporate failure. So if I have other cultural factors which make me cannot sell my product, it will also lead to the corporate failure, because I will search about another market to go through it, and I will need to make other marketing costs. These marketing costs will cost me, or will have me the inability to sell my products also, so I'm going to face a higher level of corporate failure. So what about the economic instability? The environmental economic instability can lead to corporate failure, and the reason being that any downturn in the economy can be due to the firm's inability to sell its products. So if the firm have inability to sell its products, this means that we have an economic instability, and this will lead to the corporate failure. So what about the public policy? Public policy is a very important external source of the corporate failure. How? As when the government policy is against the interest of the firm within a short-term period, this means that we have another policy in our market, or in our corporations, which makes each one to think about his interest and leave the objectives and achievements of these corporations. So we are in a conflict, so we didn't have a public policy, and we are going to have a corporate failure. So the public policy is a very important external source to corporate failure, so we should avoid this policy. So the possible effects of corporate failure include what? Include the increase in the level of unemployment, include the decreasing standards of living, include the underutilization of resources, increase in the crime level, instability of banking system, and instability of the financial markets. So the possible effects of corporate failure: if we have a corporate failure, if you cannot pay our liabilities, if we cannot have a sufficient capital to buy fixed assets, if we cannot sell our products in the competitive market, if we have higher costs for production, and so on, this will affect the increase in the level of unemployment, and this will decrease the standard of living, and we will have underutilization of resources and an increase in the crime level. So we will have instability banking system and instability financial market. So the corporate failure production models is going to be like these models. Corporate failure models can be broadly divided into two groups. The first one, the quantitative models, which are based on published financial information, and qualitative models, which are based on the internal assessment of the company. So for the qualitative model, I need to have an internal assessment in my company, and for the quantitative model, I need to base on published financial information. Okay, so these are the two models of corporate failure that can be like a production models. So what is the source, or what is the indicates of the likelihood of failure? How can I know if I in my corporation, or if I in my firm, that I have a corporate failure sooner or later? This with a ratios. This with ratio that is less than 1.81 means that companies with a Z-score of below 1.81 are in danger and possibly heading towards bankruptcy. This company is in a poor situation towards the bankruptcy. So if the ratio is between 1.81 and 2.99, means that companies needs further investigation. So if this company have a further investigation, this will lead to avoidance of corporate failure. Okay, what about this ratio to be 3 or above? This means that this corporate or this corporation are financially sound. How to calculate this ratio? This ratio about the Z score, how to calculate the Z score, we have a formula that we have made or we had made in the midterm exam, which is Z score equal 1.2x1 plus 1.4x2 plus 3.3x3 plus 0.6x4 plus 1x5, and we have x1 for working capital over total assets, x2 return earnings over total assets, x3 earnings before interest and tax over total assets, x4 market value of equity over total liabilities, and x5 for sales over total assets. And before the midterm exam we have solved this question and we face it in the midterm exam, and I think you practically can do it again. Okay, so what about the fair value? The reasons for interests of the fair value. What do we interest about this value? There are at least two reasons for the increased interest regarding fair values in the financial statements. The first one is the global corporations that we have. The second one is our intangible assets. So I need the fair value to face these issues. Okay, so where are the fair values used in the financial statements? How to use the fair value in the financial statements? Here we have a schedule and description of use. At the first one, we have investment securities, then we have financial assets accounted for using the fair value options, the long-term receivables, the pension plan assets, and so on. Each one of them has its description of use of the fair value and how the companies started to face these items. So have a look on this schedule for the financial statement items and the description. So what do we mean by fair value? How do we can define this terminology? The fair value can be considered as the piece that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants and the measurement date. So the piece that we have to sell an asset or pay to transfer a liability between market participants, this means that we need to take into our considerations the fair value amount. Okay, so here the key concepts in estimating the fair value. Okay, how to estimate this value? I need to have a hypothetical transaction, I need to have a principal market, I need to have market participants, I need to have the highest and best use of this value. For the market participants, the price that would occur between two unrelated and informed participants. We have two participants. Those participants are unrelated and named as market participants, so they can decide the market value of this asset or whatever the item which they are going to sell. What about the highest and best use? The asset will be sold to the market participants who will use that asset in the most valuable way. So if I use these assets in the most valuable way, this means that I have the highest and best use of these assets and I can predict or estimate the market value of this asset. So what about the valuation techniques and income approach and cost approach? What do you mean by all of that? We have a valuation technique to evaluate or to value the amounts of the market value. We have market approach, which have uses data from market prices for identical or similar assets. If we have an identical and similar assets, what is our situation? We have also the income approach, which is based indirectly or directly, whatever, the discounted cash flow analysis. We have also the cost approach, which is based on the replacement cost of an asset. So the market approach is by using data from the market prices to determine the value of the identical and similar assets. The income approach is based indirectly or directly on discounted of cash flows analysis. The cost approach is based on the replacement cost of an asset if you are going to replace your asset with another. So what about the fair value disclosures? What do I mean by disclosure? Disclosure means that I have to mention the fair value that I have used in my company or my corporation in my financial statements to have the disclosure information at the end of the year, or what else. Okay, so the fair value disclosure, I need to have the level I inputs, the quoted prices and active market, the most reliable and less uncertainty, the level 2 of inputs, which is observable input other than quoted prices in the active market, intermediate reliability, level 3 inputs for the unobservable inputs, the lowest level of reliability, and the client generated, how to generate a new client. Okay, so the fair value disclosures should be have level 1, level 2, and level 3 inputs. Each one has its requirements. Okay, here these fair values disclosures fall into two categories. The first category is for assets and liabilities that are measured at fair value. Okay, and the most balance sheet items are not reported at fair value but are reported at another fair value amount that is occasionally. So here the most balance sheet items are not reported at the fair value on the recurring basis but are occasionally reported at the fair value. So today we have made our second revision for this course, and I hope that I cover the main points of the lectures that we have taken offline and online, and I hope that you have a look on your book to take more details about each topic. I hope that you are good listeners, and I wish you can solve in a correct way in the final exam. Thank you and goodbye. All the best.